Welcome back to the Business Exit Value Strategy. In today's tactic, we will discuss the one objective and to define what is equity. This is the Business Exit Value Strategy with one objective, 7 goals, and 500 tactics. Statistically, only 25% of businesses continue beyond 15 years, and only 25% of those will sell. Why is it only 5% succeed? We have analyzed mid-sized companies for over 20 years. There are proven methods and common mistakes to success. This is the business development outline for you, the principal, to finish well and have a future assurance with real estate investments. Now, let's jump into today's tactic. What is equity? The simplest definition may be equity is the value of an asset minus debt. A debt may be easy to determine, such as the balance due on a loan, etc. However, the value of an asset may be viewed in different ways. An asset may be viewed as the purchase price minus depreciation for tax purposes. In this instance, the asset may have book value according to the financial balance sheet. In the case of multiple principals, equity represents the value that would be returned to the company's shareholders, or owner's equity for privately held companies, if all of the assets were liquidated and all of the debts were to be paid off. In a publicly traded company, the value may be determined by the market price. In the case of an acquisition, for accounting purposes, the buyer may value the company by the sales price minus any liabilities owned by the company and transferred with the sale. Value, debt, and equity may be changed. A popular assumption is that equity will increase as a company grows. The reality is that it may, depending upon 2 factors and many conditions. The 2 main factors that control equity are value and debt. So there are many conditions. Value may be determined by the amount that the buyer will buy and the seller will sell an asset. The people may pay more in a bull market when prices are rising. The same goes for economic conditions, which is consumer behavior determined by trust in a social and political environment. Economics should not be confused with finance. Economics is an external condition hard to personally control. Finance is an internal condition that may be managed with self-discipline, choices, and priorities. Finance and capital differ as well. Historically, the company finances were defined as the accounting of the internal funds. Today, finance has been labeled as to be financed, otherwise known as obtaining a loan. The term capital, too, has changed in meaning. Historically, capital was the monetary holdings of a company. Today, it is assumed to mean investor funds. Every transaction of an asset is as unique as our DNA and is determined by the expectations of a seller and a buyer. For example, there are personal seller motivations such as distress or no urgency situations. There are buyer opportunities such as market timing and adding value that influence decisions. For the principal, the greatest active approach to build equity is to eliminate debt. The bottom line, value is a factor that changes. Debt is a factor that either is a constant or may be removed. The highest net equity over time is achieved by debt-free operations. Stand by for this week's chance to win a free gift. If this tactic was helpful, please like this video. Also, please subscribe to hear more tactics soon. And you may order the book, Business Exit Value Strategy, have your people attend individual tactic online courses, or contact us at tobiasbalda.com. For a chance to win our weekly free gift, the Hope and Courage Anchorline hat, please submit a request or question in the comments section.